Steve, are you literally putting IKEA furniture together right now?
It's not IKEA, but it is furniture.
Nice. Well, you don't appear frustrated, so I should have known that it wasn't IKEA.
I have 80 pieces of IKEA closet upstairs right now that I'm gonna have to deal with sometime.
I tried to convince Jenny's two sons to start a business putting IKEA furniture together.
I raised him smarter than that.
You did. You did. Morning, everybody. I'm going to go ahead and dive in so that we have the maximum amount of time for questions and answers in case there's a lot of burning questions. We'll kick off. I'm just going to do a little recap on what we talked about in classes 1, 2, and 3, and then what we're going to talk about here in class 4. Really appreciate you guys sticking with this. I've gotten really great feedback from several of you, just in terms of how it feels pretty healthy to kind of force yourself to think on these long-term, lifetime type financial questions. I find the same to be true. I don't think this is something that comes naturally. I think it's something that you have to really force yourself to spend time thinking and planning and stretching your mind about. So I really appreciate that feedback. So in the first session, I shared what my take on the problem is. So kind of why is this topic necessary? I think it's a lack of financial literacy just as a result of how we're conditioned to think about money in 30-day periods of time, as opposed to lifetime accumulation of wealth. And even the word wealth, having certain kind of predisposed ideas in our mind, and my challenge to rethink those. We talked about Rich Dad, Poor Dad. I haven't spent much time talking about the other 3 books that I've recommended for additional reading. I do hope if you find yourself intrigued and motivated, but confused, if you're kind of in that space of, okay, I know, I get it, why this matters, but my head is still spinning on this mindset and how it impacts life and decisions, that you're probably right in the right spot to engage in a few more of those books. Richest Man in Babylon, Millionaire Next Door, Think and Grow Rich, and there's quite a few others that I would recommend. And I think you got to go into those books the same way I would say you go into Rich Dad, Poor Dad. Not every bit of content in the book is fantastic, or you're not going to agree with it. But there's some life-altering content. I really believe that. And so I'd encourage you to engage in those other books. In the second session, we looked at a profit loss and a balance sheet. Looked at just kind of the business principles behind the two of them, what makes them different. So reminder, profit loss is that summary of income and expenses over a certain period of time to tell you how much money you made or lost. Balance sheet is a statement of assets and liabilities. So a immediate snapshot. Then we talked about the personal financial statement as the individual version of a balance sheet and why that's important. Third session, we talked about a couple different things. We talked about investment rather than expense, net worth versus income, tax strategy, whether you're investing in real estate or not, and using debt as a tool. I think the third session is probably where heads are spinning the most because it feels like we're kind of jumping around and talking about specific things. I would just say, in as much as anything from that session just doesn't compute, or you're just kind of like, oh gosh, I still don't get it. Know that you have a lot of people around you that could help you think through that, myself included. So what at any point in your career, if I can help you think through any of that stuff, please let me know. Today, we're going to talk about personal financial statements a little bit more. I'm going to answer some questions about that, hopefully even some more questions than I have currently, but I have some good ones. We're going to do a Q&A on the personal financial statement or anything else. And then I'm going to talk about what your goals are. I don't know what your goals are, but I'm going to talk about some thoughts about what they should be, how you think about them, and in particular, calibrating at least some of your goals to your personal financial statement rather than your tax return. We're going to finish with the goal setting portion, okay? So we're going to start with some questions. First, I'm going to say I already have 5 of your personal financial statements, which is great. Now I know who the students were when you were in high school who turned your work in early. I know who you were, which was not me, by the way. I'm the student that would be turning in my personal financial statement in about 2 weeks. But it's good to get those 5, and I'm sure I'm going to be getting more. So yeah, unfortunately, I don't have the power to give you a failing grade and force you to take the class again if you don't submit your personal financial statement. So I don't really have that much leverage, to be honest, but I do want to force you to demonstrate to me that you engaged somehow with the personal financial statement, because I think it's a really good exercise. So I'm going to start with a couple questions that I have already been asked about the personal financial statement, and I'm going to share my screen to pull up that same sample that we looked at earlier. So I'm going to start with these. I have 4 questions that people have sent along. I'm going to start with those, and then when I'm done with those, know that this is the place to ask questions about the financial statement, okay? Let's see. Okay, y'all can see that, right? Okay, so I got a couple questions about the asset side. So the left side of a personal financial statement. One is, and I noticed in one of the statements that was sent to me, I think someone did this, and then I also got a question about this. So on the asset side, when you're entering in something that you own that is worth some value, you're attributing a value to it, you are putting on the asset side the entire value of that asset, not the equity that you have in that asset. So the difference there would be, we'll use real estate. You all understand real estate. It's a pretty easy example for this because you oftentimes would have debt. if you owned an investment property that you think is worth $100,000 and you also have a $60,000 mortgage on that investment property, you have $40,000 of equity, you have $40,000 of net worth in that asset, but the asset's value is $100,000. And the way that you would show that on your personal financial statement, I'll just do it right here. This is how you would show that rental property. You think you could sell the home for $100,000, therefore its market value is $100,000, but you owe a bank $60,000 against that asset. You could put it here under other liabilities. You could restructure this to add more lines and put it there. The reason that you show it this way, it's still going to get to this 40, right? This is a really helpful way, particularly as you start to get more assets and more liabilities. It's a helpful way to show how leveraged you are. In other words, you could try to create a personal financial statement where you only showed the equity. You could say, well, I don't really own $100,000 of that value. I only own $40,000 of that value. And you could show it like this, still showing the same net worth, right? But the problem with this is your debt to asset ratio here would be 0, which is not a true picture. That is a true picture that would show a debt to asset ratio of 60%. Getting into the weeds a little bit about how a personal financial statement will impact like future decisions and conversations with bankers. But this is one of the reasons that a really clean assets on the left, liabilities on the right is helpful, is because it not only shows you how much net worth you have here in this column, it also very quickly shows you your total percentage of your assets that have debt attached to them. So let me give you a couple examples here. 2 individuals that have a net worth of $2 million, okay, can have very different personal financial statements. One individual could have a net worth of $2 million and have assets of $10 million. Okay, you have $10 million in assets, but you owe $8 million in debt. Your net worth $2 million. Individual number 2, $2 million in assets, no debt, same net worth. There's not a better or worse there, but the way that I would look at that, the way that investors or bankers would look at that, the person with $2 million of net worth and no liabilities might be a better credit risk because they currently have no debt. So they're more conservative. They might be safer. But if you ask me to predict which of those 2 people is going to be worth more money in 5 years, it's the one with $10 million in assets. Because the $10 million in assets, if they're cash flow generating, that person's net worth is going to climb faster. So neither 0 or 80 are great percentages. We can get more into that later, but that's why you show the total value on the left and then any debt associated with that on the right, okay? Second question. Similarly, over here on the asset column, I had somebody ask me, this is a really good question. Do I use book or market value on the assets? So you may want to jot down these definitions. Market value is easy. Market value means, what do I think I could sell this asset for in a reasonable period of time? So if I decided I had to liquidate it, what could I get for it? So what it's worth to you isn't market value. They may be the same, but what could I sell it for in a reasonable period of time is market value. Book value is essentially what you paid minus any depreciation that you have declared. So I'm going to give you an example. The way that my personal financial statement works, and probably for several of you, and hopefully more of you into the future. I'm going to put right here under businesses owned. I own an LLC that's called Nottingham Properties LLC. Very creative name. Took me a long time to come up with that. I'm sure all of you have really cool LLC names, unlike mine. But the majority of the real estate that I own is in that LLC. Okay. At the end of each year, when I want to update my personal financial statement, I need to go into the balance sheet of that company. So the personal financial statement, if you will, of that company, and figure out how much equity. So my ownership in that company, what is that asset worth? So this is the way that my personal investment real estate shows up on my financial statement. You guys track with me on that, because I own it in an LLC, and that LLC is going to have a certain value to it based upon its own balance sheet. This is a really important question, particularly with real estate. There is a rental property. Let's assume that LLC, just for the sake of making this kind of a little bit more simple, assume that LLC only owns one property. And that property I bought for $100,000 10 years ago. Okay. On the books of that LLC, that property legally 10 years later on the books probably shows that it's worth about $70,000. Okay. Because I am able to legally declare a loss against that property every year. I bought it for 100. It went in as book value as a $100,000 asset. And each year I'm declaring a loss that saves me taxes, right? And so now on my books, it shows as 70. Somebody want to tell me what a rental property in Indianapolis that I bought for $100,000 10 years ago, what's that probably worth today if I went to go sell it? Just take a guess. And dang it, I can't see the chat at the moment because I'm sharing my screen, and I'm sure I can see both of these at the same time. So somebody unmute yourself and just tell me, what do you think that's worth? Oh, there we go. Bought a rental property in Indy 10 years ago for 100,000. What's it worth today? Yeah, Brian, I think that's probably about right. Over the course of a decade, that property has probably doubled in value in most parts of Indianapolis. Okay, so thanks, Ryan, for that 200. So the question here is that I have legally declared a loss on that asset every year, and my books show 70. Now let's assume I have no debt. That would mean, from a book value perspective, I'm saying this LLC that I own has book value of $70,000. On a personal financial statement, you are not obligated to use depreciated book value. You should be using market value. You will need to have a defense at some point in time for some of the market values that you're using, but it should be market value. for better or worse, with real estate, it's always for the better because you're able to declare the loss. But a personal financial statement isn't a tax document. It's for your own purposes to be able to track your net worth and to strategize. It's for lending purposes to be able to obtain mortgages or other debt. It might be for investment purposes, to demonstrate that you're an accredited investor. So, but this doesn't have to correlate to taxes. So your balance sheet for the property, whether you own it in your name or in an LLC, you can legally depreciate the property until one day on your books, it shows zero because you've declared all that loss and saved all that taxes. So this is I know, kind of getting into the weeds here a little bit, but this is, by the way, where 1031 exchanges become really powerful tools. You have an asset that's worth $200,000. You own it for long enough. You've declared a bunch of loss and it shows as zero on your books. If it's zero on your books and you go and sell that property for $200,000, you just incurred a capital gain of $200,000 that you're going to owe a lot of taxes on. 1031 exchanges, very powerful, allow you to push all of that gain into another, usually larger piece of real estate without paying taxes on it. So we can do another session on 1031s someday, if you'd like, but so using book value here, obviously on your liabilities, there really isn't such a thing as book value on liabilities because liabilities are not subjective. Liabilities are money that you owe to someone, so there is an actual balance. Asset value, if you're talking about a checking account or a note receivable or a life insurance cash value or an IRA, they're not subjective, right? They're objective. You could look up the balance of your IRA if you cashed it out right now. Some of your assets are subjective. The value of real estate, the value of a car, the value of jewelry, any sort of capital stock in a company that you own, those are actually subjective, and you need to declare a value and then just be ready to, in some way, defend that value if you were asked. Okay. Jenny, good question. Jenny asked about how you do if you're a partner. So let's say you owned half of a company, or a piece of real estate. Perhaps you actually owned the piece of real estate, partnered with someone. You would put here what your percentage is worth. So if you owned half of a company that the owners believed to have a $200,000 market value, you would put $100,000 here, whatever your ownership share in that company is worth. Next question. I have a good question about how to record pay. Y'all are, the majority of you are self-employed. And so this is always going to be kind of an interesting area here. And income on this document should line up with your tax return. I said this wasn't a tax document. That's a true statement. And the income section here, y'all understand that this section right here that I'm highlighting, this does not actually affect the personal financial statement here. In other words, these numbers do not impact your net worth. Here's the difference between net worth and income, right? Income can be helpful because sometimes, particularly a banker, when they're looking at this, the net worth matters to them. So does the income. So many of you have set up some form of a corporation that you're paying yourself salary from. So let's say you're a realtor and you earned $150,000 in commission income last year, and you had $30,000 of expenses, and so your net was $120,000. but you paid yourself a $5,000 a month salary, which means you paid $60,000 in salary. The remaining
Mark, I can hear you talking in the other room, but you're frozen.
By the way, curtain bangs on point, Michelle.
What's on point?
Curtain bangs. I'm not
Curtain
sure if
bangs.
that's the style. Yeah,
Thank
rocking
you.
it.
Thank you so much, Jake.
There we go. I don't want to throw anybody under the bus, but I started talking about dividends and I saw Michelle walk back to our router and unplug it. So I'm just going to say, I mean, I don't know what happened, but okay, I'm going to share my screen again. Hang on. Back to income. Okay. So the 5 different types of income here, obviously salary is probably the easiest to understand. What does your W-2 say? Interest income would be if you had lent money to someone and you actually earned interest, you would receive a particular type of tax document that would declare it as interest income. Dividends are profits from a company that were actually dispersed to you as cash income. Capital gain is if you sold an asset for more than it was on your books. So this is the rental property that you bought for $100,000. You depreciated it over time all the way down to zero. You then sold it for 200. You would have to show a $200,000 capital gain. This would also be true, by the way, if you sold a business. That's another type of capital gain. And then the corporation gain or loss, what makes that different than the dividend is whether the money was dispersed. So in this scenario I gave about the realtor who had $150,000 in revenue and $30,000 of expense, right? It's fairly obvious that they made $120,000. That could get broken out in any number of ways here. What I'm showing is as if they paid themselves a $60,000 salary and did not disperse the rest of that money. But it's sitting in that LLC or S Corp as increased value in that company, but they still made it. It was still income. Okay, so the income here and the balance sheet portion, the personal financial statement up here, interact with each other in the same way that a business's profit, loss, and balance sheet interact with each other. Hopefully that answers the question about how to show income. Oh yeah, one other comment. Somebody, when they submitted their personal financial statement, I thought this was a great suggestion. They suggested that we should do a follow-up course next year on just kind of getting started in investment real estate. I think that's a great idea. I kind of nerd out on that stuff and would be happy to talk about it. So I think noted. And I think next year sometime we'll maybe do a 2-session Zoom training on getting started in real estate. And I think one of the reasons that can be helpful, I've referenced this a little bit, is that I think a lot of times people get kind of a single track zoomed in to one way that investing in real estate can be profitable. I think the best understanding of investment in real estate recognizes that there are 5 distinct ways to make money investing in real estate. And that oftentimes a good real estate investment is going to capitalize on 3 or 4 of those 5. So topic for another day, but know that I did hit on investing in real estate quite a bit as a good long-term wealth strategy. So we will do probably a 2-session course early next year on that. Okay, I am gonna, well, maybe I'm not gonna unshare my screen yet. Shoot, my chat disappeared. Some of you may have already posted questions. If you did, I'm gonna have to ask you to repost those, but I'm gonna start with Michelle's. Michelle's asked for book recommendations for how to invest in real estate. I actually think several of the books that we've already recommended would be helpful. They're the Gary Keller book, Millionaire Real Estate Investor. Very similar title to his famous Millionaire Real Estate Agent, I think. It's a good book. It covers the basics really well. So I like that one. There's some others that maybe dive a little bit deeper into those numbers, but I would start with the Gary Keller Millionaire Real Estate Investor. Okay, so by the way, a couple more of you have submitted your personal financial statements in the last 30 minutes. Thank you. You're also good students. Gold star. Way to go. I am going to do this because I'd love to be able to see you guys. Okay, so for those of you that haven't asked questions yet, as you're making your personal financial statement, or as maybe you have made it and you're thinking, like, what do I do with this? How's this used? I know you keep talking about bankers and how you use yours, but what questions do you have that we haven't hit on yet? Or maybe just a comment on what the experience was like doing your own personal financial statement. So Q&A right now, particularly focused on that financial statement. Oh, Angelica, yeah, I think you mean to me. You can email it to me. Several of you emailed me a link to the Google Doc, and I know it's always kind of awkward. It's like one of those things that you don't ask someone for. Guys, it's funny. Earlier in life, I was very early in the business world, and somebody had presented a business idea. Basically, they were kind of like inviting me to invest in something. And I flat out asked for their personal financial statement, and they were like, no, you don't just ask for that. That's not how this works. And I was like, partially because mine, probably the sum of mine at that point in time was like $1,000. So I was like, well, I'll show you mine. So he did not send me his, FYI. I never saw that one. I'm still friends with him quite a 15 years later. Yeah, Angelica, you can send it to me. But honestly, some of you are going to be comfortable with sending me the actual document and ask for my feedback on it. I'm more than happy to give you that, but you don't need to do that. I'm just trying to hold you accountable to doing it and learning how to do it. You can take a screenshot that doesn't show the numbers, or print it out and mark them out and shoot me a PDF, just something that I now know, like, okay, cool, they did it. Because I may or may not give a few of you a hard time if I don't get it. How's that? Other questions on personal financial statements? You can unmute yourself if you'd like, or you can comment in the chat. It's very bold of you, Silva. I appreciate it. Yeah, Natasha's asked a good question. Thank you, because somebody actually asked me that in a phone call, and I forgot that. If you're married, should you do a separate one or joint? I think the conventional answer to this is it depends on how you file your taxes. If you file jointly, I think it makes the most sense to make one personal financial statement. I think you could also probably make an argument if an individual got married but signed a prenuptial agreement. In other words, if they are without a prenuptial agreement in the United States, if you get married, your assets are considered joint. You can still file separately for income purposes. But so I would say if you have a prenuptial agreement and you file separately, you should definitely be doing your own personal financial statement. If you don't have a prenuptial agreement, you're probably filing jointly, and you would just make one financial statement. Yeah, Johanna, good question. Johanna asked, curious about how to use it with bankers. So a couple things here. I think I was telling you guys a couple sessions ago about my conversation with my banker this fall. So there is a rub in the business world as you're trying to develop wealth. I've made the case that investing in real estate, particularly that using debt wisely in investing in real estate, is a great way to generate lifetime wealth. Well, to use debt, you have to have the relationship with bankers. And some of you have experienced this. Y'all know that self-employed individuals have a little bit higher of a hurdle to get mortgages, right? Bankers are, for whatever reason, they're a little bit nervous about the predictability of self-employed income. So this is like, why does a self-employed person have to demonstrate 2 years of income when oftentimes a W-2 employee does not? We could have a long conversation about that. I think there is a ironic dependency in the banking world on W-2 income as if it's totally predictable. I maybe it's because I've been self-employed for a long time, but I kind of take an objection to that because W-2 income is perceived to be predictable. Like it's predictable until it's not, right? All the same, I can't change the criteria that underwriters in the banking world use to give loans, and they prefer W-2 income. So a self-employed person is going to have a bit more of a hurdle. Most of you are self-employed. This is the main way to overcome that objection when you're going to get debt. A really smart self-employed person is never going to be able to demonstrate their full capacity using tax returns. I'll say that again. A really smart self-employed person is never going to be able to demonstrate their full capacity using tax returns. Why? Because you're not going to show a lot of the money that you really made. And the more money that you're making and the stronger your personal financial statement, the more that is true. We talked about the politicization of the billionaire paying less than $1,000 a year in income taxes. That means that billionaire is filing tax returns that show no income, zero. But yet they can go out and borrow money. It's off of their statement of net worth. So the security to the banker from the person's signature is not a claim on that person's income. It's a claim on that person's assets. See the difference? Particularly true for a self-employed individual.
I have a question, a follow-up question, Mark.
Yeah.
So I'm thinking about this for myself, obviously, but also I have a friend who is a hair salon owner, and she, for the last couple of years, has wanted to start the process of buying a home, but has run into the same rub with bankers, and has been relying exclusively on her tax returns, and accordingly has been getting some disappointing responses. Should she go back to those same lenders with her personal financial statement instead? Does she need to try to reach out to new lenders? Is it a situation where she can come back and be like, oh yeah, but this?
It's probably three things, or a combination of some of these three things. Number one is, I think the right banking relationship does make a big difference for a self-employed person. I'd like to think I'm a decent credit risk. Knock on wood, I haven't defaulted on a loan yet in my life. But there are big banks that would not lend me money because they don't have a category for it, right? I tend to find better success with smaller banks. They tend to be able to nuance more. So this is the, like, Wells Fargo is going to throw their hands up in the air. If any of you like Wells Fargo, I'm sorry. I'm from Richmond, small town on the east side of the state. And most of my banking happens with these two very small banks in that town because of this. So right banking relationship does matter. Number two, yes, I think going back to them with a personal financial statement, particularly if it's a strong personal financial statement, if it's negative or close to zero, it won't help her case. But if it's a strong one, absolutely, yes. The third is the play between those two documents. So this is the conversation I was having with my banker in August. Okay, what do you need the tax return to say? If I'm going to need to be able to borrow money, let me have a conversation with you. Should probably be over the phone, by the way, not a good email conversation. I don't think a banker is going to go on record as saying, please make sure your tax return says this. But that is the way these things work, particularly for self-employed people. I want to hear from the banker. If I can establish that relationship and say, hey, I'm going to want to borrow money next year, give me some feedback, because I don't want this number on this return to be any higher than it needs to be, because I'm just sending money to the federal government at that point. Good question. I'm still getting submittals of your personal financial statements. I love it. Before we transition topics here in a minute, any other questions on the personal financial statement? I can assure you, if one of you is asking the question internally, you are not the only person on this call that's asking it. So no stupid questions. Okay, good deal. I'm going to transition. Questions on other aspects of what we've talked about. So the mentality about money, I think this is the one y'all have been beating it in, right? The shifting your mindset from thinking about money as I have income and expenses. What's the difference between the income and expenses? That's how we're conditioned. Transitioning from that to a balance sheet, personal financial, lifetime accumulation of wealth, that mindset shift. The word wealth, we talked about that. Any of the things we hit on in the third session. What questions do you have, or just feedback? Some of you have kind of individually given me feedback on what this has been like for you to kind of rethink these things, but questions that you have on the mindset shift or any of the specifics that we talked about, profit loss, balance sheet, tax strategy. This is the moment, by the way, where if we were in person, I could make awkward eye contact with one of you until you felt like you had to ask a question, and it doesn't work on Zoom. So one of the things I don't like about Zoom. Angelica asks, what if I haven't been working with a CPA all year? Can they save me now? I don't know if a CPA could ever save you. I do think a conversation with a good CPA between now and the end of the year is a worthwhile conversation. They may not be able to impact your 2020 taxes very much, but the best possible time is now to initiate that conversation. One of you asked, I love the way that you asked this question. When you submitted your financial statement, you said something like, I need a new CPA that doesn't just take numbers from a spreadsheet and file a tax return. I need somebody that can help me think strategically as an independent business owner. And I totally agree. Honestly, if a CPA is just pulling monies from a spreadsheet or pulling numbers from a spreadsheet to just file your tax return and tell you what you owe. I'm not trying to be offensive or critical to that person, but you could do that on any number of web-based tools. Where a CPA is really worth their money is long-time tax strategy. Quick question about 1031. Can you use those funds in multiple real estate purchases instead of just one bigger property? Yes. Yeah, but 1031 capital gain can be distributed to multiple properties. Yep. I think that we'll probably hit on 1031. That'll be a part of the investing in real estate, because one of the 5 ways you make money is capital gains. So we'll talk about that. Brent asks, how does this document reduce your likelihood of being audited? How does it play within that situation? I don't think it has much impact, that your personal financial statement and whether or not you're going to be audited. Your tax return and how you handle your taxes. So a good CPA, I think, not necessarily prevent you from being audited, but can give you the right advice in terms of, hey, that's a red flag. Let me give you an example here. If you own a $100,000 rental property and you claim to have spent $40,000 in 1 year on maintenance at that rental property, a CPA is going to say, nope, that's a red flag. You may have spent $40,000 on the property, but it's because you replaced the roof. The roof isn't considered maintenance. It's a capital improvement. They can explain the difference there. Here is where a relationship to a good CPA really matters, right? In that one thing, you could be talking about thousands of dollars of impact to your tax strategy, and you might pay somebody $500 for the year, right? So the ROI on a good CPA is like one of the easiest things in the world, the more that you're doing investments. I think I answered your question, Brent. I got off topic, sorry. CPA recommendations. Yeah, a couple of you have asked about this. I will, I'll send out a recommendation. I work with someone in Richmond who I really like. I know a lot of people here in Indy would rather work with somebody in Indy, which makes total sense. And I actually might prefer that. I just have this really long relationship with someone in Richmond. There are a couple other plat agents actually that work with that particular CPA too, just because I've connected them. So I'll send that out. I'll also maybe try to get a few more, just to try to make sure people have good access to somebody, because it's a key relationship. Leslie says, if I'm understanding a 1031 correctly, it's a tax deferment. When, if at all, does this catch up with you? When do you have to pay taxes on the gain? Fantastic, Leslie. You've nailed it. You're exactly right. It is not an elimination of a potential tax burden. It's a deferment. And by the way, pretty much any legal tax strategy is a deferment of taxes. The goal is always to push the taxes as far into the future as you can. Partially because of the time value of money, but also partially because eventually you don't pay them if you indefinitely keep pushing them into the future. So it is a deferment. Leslie, the answer to that question would be if you sold the new property. So you sell the original property, you make $100,000. You take the $100,000, you push it into a 1031 and buy something else. You have deferred the taxes that you would have had to have paid on that $100,000. You then go and sell the replacement property. You would then owe the taxes on that, on the original gain and the gain on the replacement property. What people generally do is 1031s build on each other, that you never fully exit the real estate, because as you buy more and more expensive real estate, your ability to actually capitalize on the wealth through cash flow and debt. So in other words, you can actually get the money out, without selling the asset and incurring the tax gain. So generally, when people start doing 1031s, they never get out of the cycle because they don't have to. They're just building more and more wealth without paying taxes on it. i.e., $750 in taxes for a personal financial statement that is something like 12 digits long. Yeah. I should stop making jokes about that. Thanks, Joel. Joel, if you could shoot me that contact, I might include that with a few others for the CPA recommendations. Thank you. Yeah, Kristen, good point. So here's a couple variables. There are, like if you replace a roof, Kristen was saying on a duplex, if you replace a roof, you can declare 50% of that in a given year as an expense, which means you've improved the value of the real estate, but you can declare the loss. You're moving in the right direction on both ends there. Like a commercial building is a little bit different. An apartment building is a little bit different. So there's different rules out there. Where again, my take on this is don't become an expert on tax strategy. Work with an expert on tax strategy. Joel, it really does depend on the property type and what type of improvements, because there's some subjectivity there. For example, I own a building where I did like this big overhaul on the windows. The windows they were really wooden windows that had gotten really bad. And I had someone rebuild all of the windows. So we didn't actually, technically it wasn't a replacement, but the dollar amount actually kind of looked like it was a replacement. It was a pretty big investment. But you could see that there you could make a subjective case about like, well, we were coming in and pulling out pieces of wood and replacing it. That's maintenance. So just as an example where you kind of get into a subjective, that's where I think a CPA could say, hey, like I am licensed. I'm a licensed CPA. I can provide you a professional opinion on what's reasonable. Because if you were to get audited, your CPA is the one that's going to help you defend the decision. Like, yep, we talked about that. Here's the methodology that I used, as opposed to you as an individual saying, I don't know, I didn't want to pay taxes on it. These are firing away good questions. Love it. Any others? Is anybody willing to say their perspective on money has radically shifted in the last 14 days? Any like testimonials? I doubt that's the case. It doesn't happen like that. It's like a lifetime of rethinking. Okay. There you go. Chris Glassburn talked to her CPA for 2 hours this morning. Might have been an expensive 2 hours, but it was probably the best 2 hours that you will spend all year in terms of ROI. I love that. Angelica says, how do you get clients to understand the leveraging of debt? I find that a lot of people who don't come from wealth are afraid of leveraging debt. 100%. And with good reason. Like the fear surrounding debt comes from a rational place because people have seen debt crush someone. So it doesn't come out of nowhere. I think running through examples like I did in the third session, we're looking at the power of debt, just kind of run through try to keep it simple in terms of like, if you have this much money, there's 2 ways you can go and buy real estate. We could, that is recorded. You could, I'm not saying I did it perfectly, but you could just use that as a test case. You could also encourage them to read some literature. Any book on real estate investing tackles the power of leveraging debt. And so kind of like punt it to a professional that's written about it. Yeah, Chris is not wrong. Her CPAs in Kokomo, same as Richmond. The market on the rate for a good CPA probably is different in Indianapolis. I don't have a relationship one in Indy myself, so I guess I don't know that, but you're probably right. Feel free to keep posting questions, but I am going to transition into talking about goals as our wrap up. And what I want to challenge you with here, we chatted about this really briefly in the first session. I've referenced it a few times, but I think most people in our industry set goals based upon revenue. Fair? They may not actually set a revenue goal, but some component of their goals is directly correlated to annual revenue. So if it's not, I want to make $100,000 this year, it might be, I want to sell $6 million of real estate this year. Well, setting a goal that says I'm going to sell $6 million of real estate is pretty much like setting a goal that says I want to make X dollars. It may not be about the money, but the goal is still associated, directly correlated to revenue. And I am not anti-revenue goals. I am pro-revenue goals. I think that as a self-employed individual, setting goals and setting vision is a critical part of long-term success. So absolutely, you should be doing it. I do the same. What I'm going to push you toward is that I think a net worth goal is a larger and more important life-altering thing. And that if you're only setting revenue or income goals, you're missing out on future opportunity. And so I think you have to have both. And a net worth goal, I think this feeds in a little bit. I just want to address this again. I think it feeds in a little bit for some of us into some of those negative, conscious or subconscious opinions about the word wealth. I think there might be a comfort level with saying, I want to make $100,000 that doesn't exist with saying, I want to be worth $5 million. I am acknowledging that. I have even had, I remember this. I've had someone, when I was talking to them in a one-on-one meeting about their kind of personal financial situation, we were talking about this very thing, and they said, no, I'm not one of those people.
Go ahead.
So what do you mean? You're not one of those people? What does that mean? Like, I'm not one of those people that thinks about my, what I'm worth financially or sets goals according to that. And it was very much driven by a kind of a family backstory negative towards anybody that sets a goal for their net worth. I have this negative opinion towards that. And I'm not suggesting you need to land like in the same place I will land or anybody else. I just want to challenge you to like dig into that. If that's you and you're feeling that, why is that? Where does that come from? I think, I think, Joel, it's interesting. I think self-worth is maybe a part of this. I think people tie self-worth to what they make in a year, but they also tie self-worth to what they're worth financially. I just want to, human beings do that. So to get real for a moment, I don't think it is avoidable to wrestle with the tension between money and what you think about yourself. You all do it. We all come from very different places, and we all have different positives and negatives in terms of like, my net worth is $100 and I'm proud of that. Or my net worth is $100 and I'm ashamed of that. Those both happen. But I think you got to wrestle with it. So I don't want to spend too much time on the philosophy, but I know if I'm challenging you to set a net worth goal, then there's going to be a psychological challenge to this for some of you. Yeah, Ginny, I'm going to circle back to what I think a good net worth goal looks like, because it is a different answer for all of us. My starting point on this is, number one, you got to figure out what your net worth is right now. This is why I'm pushing the financial statement, because you have to start with that. Number two, a net worth goal is different if you understand cash flow producing assets. So if you understand money as something that comes and goes, it comes in or it goes out, it's income and expenses, the traditional understanding of money. In order to retire, you have to figure out, well, I think I'm going to live for 30 years after retirement, and I need $100,000 a year to cover my standard of living. So I got to get to $3 million, right? No, wait, did I say that? Yeah, I said that right. There's a really big distinction there, though, because that goal assumes that you retire and you stop making money when you retire, and the money just bleeds until it goes down to zero. A cash flowing asset and an understanding of a cash flowing asset will hold your net worth accountable to making money. And so here's what I would say your net worth goal is oriented towards. What day in your life do you want to go to work because you want to, not because you have to? You have to ask that question. What day in life do you want to go to work because you want to, not because you have to? I'm not much on the concept of retirement. I don't think I'm ever going to retire. It does not sound fun to me, to be honest. But I do want to hit a point. I have a very specific day targeted that for me, I'll just tell you guys, it's my oldest child's 18th birthday. Before that day, I want to be able to have a net worth and a kind of overall financial setup that at that point I am choosing to work because I want to. And I think I will for the rest of my life. If you don't think that's possible for you, you're wrong. I'll just say it. It is. Your mindset has to start now. I don't mean to be argumentative or to, be, not understanding about your challenges. I know there are some really big challenges. That is feasible for you to declare the day that you want to be able to work because you want to. It starts with that. And then you back into a strategy to create a net worth by that day that can cover your standard of living for the rest of your life. And so for me, I think about, okay, well, I think my family probably needs X dollars a year to live the way we want to live, okay? And I am confident that I can return Y% per year off of my net worth. So I'm going to make this easy and say, if my family needs $10,000 a year to live on, FYI, we need a little bit more than $10,000 to live on, but if my family needs $10,000 a year to live on, and my experience tells me I ought to be able to conservatively produce 5% a year of income off of my net worth. If I ensure that my net worth is primarily tied up in cash flow, income generating assets, be they businesses or real estate, stocks, whatever, the market historically performs better than 5%. Real estate clearly performs better than 5%. So I want to use a conservative number. If I need $10,000 a year and my net worth confidently can produce at least 5% a year, how much money do I need on my personal financial statement to walk away? Anybody? It's 200 grand. If my net worth is $200,000 and I'm confident in my ability to ensure that that $200,000 net worth is generating 5% a year, that's $10,000 and I can live off of it. That means if I continue working vocationally at that point in time, it's because I want to. Now, none of you can probably live off of $10,000 a year. Well, you could, but none of you are going to set that goal. Some of you might add a zero to those numbers that I just gave. You might say, I want to ensure that I have a minimum income of $100,000 a year. And if that were the case, then I'm in the point of like choosing to work or not. And I think 5% is a good number to start with in terms of not being too aggressive. Well, okay, that means your net worth goal is $2 million because that's the day that you can choose to work. Then you got to back into something else. So you see, I'm starting with the end in mind. The end in mind is the day that you don't have to work anymore. Then you declare an annual income that you need. Then you declare a percentage that you can believe, or a percentage that you believe you could return ROI or net worth. Then you declare the net worth balance that you need. And then you back into a strategy to get there. So, okay, I know I need my net worth to be $2 million bucks. And I just finished my personal financial statement and I'm at negative 20,000. I'm going to start to work on a realistic plan to get to 2 million. If you're worth negative 20 and you need to get to 2 million, you guys, this is maybe it just sounds like an obvious question. How, yeah, Jenny, that's, I think why the 20 times is a factor is because 5% is kind of considered a conservative. You're going to outpace that in most cases, but okay, so this is maybe an obvious question. If your net worth is negative $20,000 right now, and you're telling me $2 million is the net worth goal, how does one increase their net worth? It's not a hard math problem. You probably know the answer. I don't want to give it. It may even more obvious than that. Yes, Ryan, this was actually a 6-hour funnel to land at that. I love it. No one's given me the answer yet. If on January 1st, my net worth is negative $20,000, and I say by the end of the year, I want my net worth to be $20,000, not negative $20,000, positive $20,000. How do I do that? In 1 year, math formula. I'm pushing you guys on this because this gets at the difference between a profit loss and a balance sheet. More assets, less liabilities. Okay, that's true. The columns have to change. Something in the columns would have to change, right? Yes. Thank you, Joel. Joel says make 40,000 in excess. In excess of what? Close. You said current net income. Johanna nailed it. Expenses. So here's how these two concepts and documents intersect with each other. If my personal financial statement shows negative 20, and I've set my goal at 2 million, now I can start to plan out a 5-year, a 10-year, a 20-year route to go from negative 20 to 2 million. And in year one, I say I got to get from negative 20 to 20 positive. The way to do that is in that year, I have to make $40,000 more dollars than I spend. It's the only way to accumulate wealth. I have to make $40,000 more dollars than I spend. Then the question is, how does that $40,000 show up on my personal financial statement? And there's all sorts of ways that it can. If you make $40,000 more dollars than you spend, a couple of you gave me some examples here. If I made $40,000 more than I spent, I could go and buy a piece of real estate. And that piece of real estate is going to drop onto my personal financial statement, therefore increasing my net worth by $40,000, right? Or I could pay down debt. I have a $40,000 student loan. I got to figure out how to make $40,000 more than I spend this year. Do you all understand the difference between investing and spending? Because somebody might look at this and say, wait a minute, if I made 40,000 more than I spent, but then I just pay off a $40,000 student loan, I didn't make any money. I just spent it on my student loan. No, you didn't. You spent that money when you went to college. You improved your personal financial statement by $40,000. That's all that matters. How it drops onto the statement is an important question, but it's much less important. Spend less than you make. This is Richest Man in Babylon. Y'all, it's a cheesy book. There's a chapter in Richest Man in Babylon. I think the title of the chapter is, it's something like Grow Thy Purse to Fattening. Because it's like set in like antiquity. I mean, yeah, I know, Jenny, stop. But it's an entire chapter dedicated to, you cannot grow your personal financial statement if you don't spend less than you make. This is where I'm totally on board with Dave Ramsey, right? So you got to start there. Make sure that your personal net worth is going up every year by spending less than you make. Then you can start to strategize about, what do I do with that wealth? Do I pay off my student loan? Do I get rid of my home equity line of credit? Do I pay it down? Do I buy a piece of real estate? Should I pay off my car? Should I invest in a business? All sorts of ways that you can use that wealth. And spoiler alert, what happens is that the larger your net worth, the more aggressive you can begin to become with the gains. So the larger the number on the net worth side, the better the return you're going to be able to get. So you might have a student loan at 3%. I think a lot of student loans are probably somewhere around 3% if they're not deferred. And you might be in a financial position where you would say, you know what? Right now, that $40,000 gain, I need the mental space. I need the monthly cash flow. I should pay off my student debt. That's how I'm going to improve my personal financial statement this year. To get from negative 20 to 20 is I'm going to pay off that student loan. Later in life, when you're in a more secure financial position, you're probably going to look at that and say, wait a minute, I'm making 11% a year on average on my real estate investments. I'm not paying off 3% debt. I'm going to pay that off as slowly as I can because it's a better financial decision to go and buy a real estate asset with that $40,000. May not be the right thing for you to do yet because of your risk tolerance. This is where a CPA or friends or other, peers or financial advisor can really help you think through those. Right now, what I'm pushing you toward is set the goal. Start with the end in mind. What's the day that I want to be able to go into work because I want to, not because I have to? How much money do I need to make a year to live? I'm going to suggest you use the 5% annual ROI. So what do I need my net worth to be? What is it today? And how can I build into that net worth? Now, I would suggest most people should not be setting up what I would call a straight line to that net worth. If the day for you is 10 years from now and the number is $2 million and your net worth is zero, you could say, well, okay, I have 10 years to get to 2 million. I'm going to have to increase my net worth by $200,000 a year. In theory, yes, on average, you do. But that's not how your net worth is going to climb. Because y'all understand that it takes money to make money. You've heard that phrase. Someone with $1 million of net worth can much more easily make $200,000 in excess of what they spend in a year than someone with $0 of net worth. So what's going to happen is your rate of growth in the net worth, it's not going to be a straight line. Increasing your net worth by $20,000 in year one could be a really great outcome. Then you start to get really strategic about what am I going to do with that 20? How am I going to leverage it? Now, all of a sudden, by year 5, you look and say, gosh, I was at 0. I needed to get to 2 million in 10 years. And by year 5, I'm only at $300,000. Like I'm only 15% of the way there. And I've lost half the time. You're right on track. It's the time value of money. It's called compounding return. You're making more money off of more money. So don't get discouraged about the, holy shit, my goal feels unattainable because I can't envision increasing my net worth by that much money right now in a 12-month period of time. It's exactly right. If you could envision increasing your net worth in a 12-month period of time at what the future average of your increase is going to be, you probably didn't set an aggressive enough goal. So it's going to be hard to see it at first. Natasha has asked, this is probably based on risk tolerance, but when you consider how much you need to live for when you choose to work, are you planning for house paid off or still have that money working in cash flowing assets? Yeah, it's a really good question. It could be either way. Yeah, I think most people are assuming at that point in time that their primary residence is paid off, therefore affecting how much money they need to live on. But what I would say is it costs you money to live in your house, whether it's paid off or not, right? Taxes, insurance, maintenance. So assume those things and that the interest on your mortgage is an expense that you may or may not have. But the longer you go, the more you'll be able to kind of really quickly evaluate things like that. It is also a function of risk tolerance. Yeah. I will likely never have my house paid off. I can borrow money against my house right now at 2.5%. And I know I can beat that by investing in real estate. I have to plan for the cash flow and the risk tolerance accordingly. It doesn't mean that all debt is good debt, but just to illustrate how that's based on risk tolerance. Having your mortgage paid off may or may not be the right goal. Having your student debt paid off may or may not be the right goal. This is why thinking about net worth as your goal, as opposed to what am I doing with my income? You can nuance a lot more. Okay. Gold star to all of you who have submitted some proof of personal financial statement. I really appreciate it. I really mean it. Everybody, I know this is, it's hitting you at varying degrees of familiarity and comfort. For some of you, this is just a good reminder, which probably says something about your family story, your story of origin, and opinions and handlings of money, right? For some of you, this is uncomfortable and very foreign, which also says something about your, story and family of origin. But wherever you are, I think there is really great growth opportunity if we can shift our mindset. Hopefully you found some of this helpful. I have a feeling that certain things are going to be helpful for some of you and other things are going to be helpful for others. But if I can be helpful, I would love to. I have about once a year, I will call a particular individual who's a mentor of mine and say, each year I become more and more aware of the value that you gave me 15 years ago now. He never gave me any money. I've never done any business deals with him. He got my mindset to move, and it's never stopped moving. And I'm like, if y'all want to take financial advice from someone who's really wealthy, I'm not your guy, FYI. But this has really been life altering for me in terms of what I'm aligning to and how I set goals and how I think about quality of life and money as something that is to be used for higher purposes. So I hope that's an encouragement to you. Oh yeah, Trisha, can I punt that to the investment real estate 101? Because it's a good question. I do Bigger Pockets. It has some good resources. I would agree with Ryan. I've never used it, but I've engaged with it a little bit. I think it's very widely used. Okay, so my goal would be maybe sometime in January. We'll do a couple sessions via Zoom on kind of investment real estate 101. So y'all, thanks. I really appreciate the engagement. I will keep my eye out for your assignments. My goal, by the way, is to, if you do send me your actual PFS, I will look through it and try to send you some questions and critiques. And then just invite further conversation to say, if you want to dialogue about this, great, I'm in. Okay. Thanks everybody. Michelle, thanks for only cutting me off once. I appreciate it. Got me to move on from dividends very quickly. Have a good day, everybody.